Thank you for joining us for today's Corporate Connect. Sorry for the little bit of delay that we are having. I'm Sunny, your host for today. This evening, we welcome Far East Hospitality Trust as well as our audience from Facebook and Mumu. This webinar is brought to you supported by SGX and organized by SIAS. We will kick off today's webinar with a presentation by Ms. Jihye, Research Analyst at SGX, on the recent market highlights, followed by a corporate presentation by Mr. Gerald Lee, CEO and Executive Director for Far East Hospitality Trust, and we'll end off the evening with a Q&A session. Listed on the main board of Singapore Stock Exchange on 27 August 2012, Far East Hospitality Trust comprises of Far East Hospitality REIT as well as Far East Hospitality Business Trust. Far East Hospitality REIT portfolio of 12 properties comprises of 9 hotels, 3 service residences, totaling 2,775 hotel rooms and 240 service residence units, offering investors an opportunity to invest in one of the largest portfolio of hospitality assets in Singapore by asset value. In addition, housed in 8 of the 12 properties in the portfolio are 177 units of commercial space. Far East Hospitality REIT also holds a 30% interest in a joint venture with Far East Organization, which has developed 3 hotels, Village Hotel Sentosa, the Outpost Hotel, as well as the Barracks Hotel, and 2 retail blocks in Sentosa. Without further ado, let's first invite Ms. Jihye to give us an overview of how the market highlights and how the market is performing right now. Over to you, Jihye.
Thanks so much, Sunny. First, I'll start off with sharing my screen here. So hello, everyone. My name is Jihye Lee. I am a research analyst at the Singapore Exchange. I'll be giving you a wider picture of the Singapore stock market with particular details on the REIT sector for some background information before we hear more about Far East Hospitality Trust from Gerald. So when we look at the Singapore market, we look at the representative stock index, the Straits Times Index. So basically this is the benchmark index that captures how the Singapore market performed. It measures the 30 largest stocks listed in Singapore. And here on this chart, it shows a comparison of the historical performance of both the Straits Times Index as well as the FTSE Asia Pacific Index in terms of total return starting from December 2019. So as you can see, the Straits Times Index has outperformed the FTSE APAC Index in terms of total return for 4 years. And as of the end of last year, the FTI had delivered almost double the returns of the FTSE APAC Index since the end of 2019. So through the FTI performance, we can indeed see that the Singapore market has been comparatively defensive throughout the different market waves. That includes the COVID challenges that we've seen, the Federal Reserve's aggressive rate hikes that we've seen throughout 2022 and 2023, and continue to do so going into 2024. There's been a number of global headwinds, including geopolitical and trade-related tensions, to name the least. But as you can see with this comparison with the broader regional index, the Singapore market has definitely proven to be resilient and defensive. It also plays into the fact that it has exposure to not just Singapore companies, but also companies that are headquartered overseas. So nearly 35% of the total market capitalization of companies listed on the Singapore Exchange are overseas companies. So here you can see the breakdown of the different companies that are listed in Singapore. We have a total of 632 companies with a market cap of $608 billion, and about 34% of those companies in market cap are from non-Singaporean companies. And within that, it also breaks down to different parts of Asia, as well as Australia and Europe and the US. What you can also see is the different sectors within not just the STI, but within among all companies listed in Singapore. So over the past years, what we've seen is that the strongest sectors that have performed in each quarter, they've generated nearly 80% of total returns for that period, while the laggard sectors declined by 50%. We've seen in the first quarter of 2020, that was when COVID first began, as well as 2022 in the second quarter, we saw telecommunications as the most defensive sector. But as we go on into the latter half of 2023, including the second quarter and the fourth quarter of last year, we've seen travel stocks and hospitality stocks underperformed during COVID and outperforming going into the latter half of last year. And going into the REITs section, so one thing that we really like to tell our investors is that Singapore not only offers a wide range of different companies listed in and outside of Singapore, but it also is one of Asia's largest REIT and property trust market. It has a total of 42 trusts with a market capitalization of 100 billion Sing dollars, with an average dividend yield of 7.1%. Now, within the REIT sector, there's also different subsegments. As you can see on the top right chart, there's different sectors. There's diversified REITs, there's industrial REITs, retail REITs, as well as hospitality REITs, which Far East Hospitality Trust falls under. And so this is sort of a glance into the different geographical locations that Singapore S-REITs, as we like to call it, are offering our investors exposure to. Now, another chart that I'd like to share here is a comparison between the FTSE EPRA Nareit Developed Index. So this index is, first of all, designed to track the performance of listed real estate companies and REITs all across the globe. This is the global REIT benchmark, as you can say. And the index is comprised of 370 constituents, of which 300 constituents represent the global REIT sector. And placement in this REIT index is very highly coveted by global REITs, especially due to the span of passive institutional investors that track the index. And the iEdge S-REIT index is the Singapore version of the basically tracking, the Singapore listed REITs. So as you can see here, the FTSE EPRA Nareit Developed Index rose about 8.9% in total returns in all of 2023, predominantly due to expectations that the Federal Reserve is done hiking its interest rates. And as you can see in the latter half of 2023, there was this massive rally from November to December. So throughout 2023, all the REITs, including S-REITs, were all down, but just in that rally in November and December alone, you see them really claw back those losses and end in the green for the year. But in terms of total returns, if we're comparing, the FTSE EPRA Nareit Index jumped about 16.99% in November and December alone. And in comparison to that, the S-REIT, the iEdge S-REIT index jumped more than 17%, outpacing that of the wider REITs benchmark index. So that's definitely worth looking into, especially when we're going into 2024 with expectations of the Federal Reserve cutting interest rates and the REIT sector being in particular susceptible and very sensitive to rate hikes and rate cuts. It's definitely a sector worth keeping an eye on. A little bit more about the iEdge S-REIT index. They include 31 constituents of REITs that are listed in Singapore, and they maintain a higher yield of 5.85%. In comparison, the FTSE EPRA Nareit Developed Index yield stands at 4.24. This is a comparison of S-REITs and property trusts, their yield in comparison to other asset classes. So we have the likes of STI index, the MAS benchmark government bond 10-year, the MAS core inflation rate. Now, looking ahead to 2024, like I briefly mentioned, REITs are particularly interest rate sensitive, and one thing that investors are keeping a very close eye on is when the first Federal Reserve rate cut will come. At first, there was definitely expectations, spotlight onto the March FOMC meeting, but now that expectation has fallen below 10%, now stands at 8.5%. So more than 90% of investors stay current status quo between 525 and 550 basis points. And now the spotlight is the FOMC and the June FOMC, more than 50% of markets expecting a rate cut of 25 basis points. So this is what we do throughout our day at SGX Research. We look at these market data and we provide market updates. We also cover our listed companies and what they do and their financial updates. So if you would like to keep up to date with these reports and would like to subscribe to our Telegram channel, you can scan this QR code here or just follow us on sgx.com. With that, I'll hand back to Sunny, and can't wait to hear what Gerald has to share for us. Thanks. Did they say? Oh, must be some technical difficulties. Sunny, are you back?
Hey, thanks Jihye for that very detailed sharing on the local market as well as the region, and also some updates on the REIT sector as well. So may we now move on to the corporate presentation by Mr. Gerald Lee to share with us their latest business update from Far East Hospitality Trust.
Thank you, Sunny, and thank you, Jihye, for sharing the business update from SGX. Let me try to get the video going, but looks like it's been controlled from your side, Sunny.
Okay, sure. Let me get our backend team to turn on the video for you.
Yeah, that's fine. Just to say hi to everyone. Thank you for taking the time to join us this evening, taking to your Chinese New Year dinner time. So I will take about maybe 20 minutes to go through a set of presentation to share more about Far East Hospitality Trust, and then we can have a time of Q&A to help everyone understand a bit more about what we do and what we're planning to do. All right, so without further ado, a quick introduction to give you an overview of our trust. First, the structure. The Far East Hospitality Trust, as you would notice from this chart here, is actually a stapled REIT and a business trust. That's why it's called stapled vehicle, but for all intent and purposes, today all our properties are all under the REIT. We have altogether 12 properties, and of this, 9 of them are hotels and 3 are service residences. And in total, the value is at $2.51 billion value at the end of last year. All these 12 properties are actually under master leases with companies within our sponsor group for the hospitality component for the hotels as well as for the service residence business. Whereas for the commercial premises within the 9 of these properties, and this will comprise the retail and office spaces in some of the properties, these are directly handled by the REIT manager, where we hire leasing people to help us to lease out all this space and to manage also the tenant relations. And that is found on the right-hand corner, the bottom right-hand side, where we have JLL as our property manager to manage the space for us. And separately, we have the leasing team from Far East for office spaces and the leasing team from JL to market our retail spaces. And today, in terms of the ownership, we have 46% of our investors coming from the public and 54% from Far East related companies. Just a snapshot of where our properties are found. Largely, they are all in the Central Core region, with only 2 properties outside, one at Village, which is the Village Hotel Changi at Changi Village, and a service residence in Hougang, which is number 12 on this chart over here, which is the Village residence at Hougang Street 91. And you'll see that most of them are concentrated along the Orchard Road shopping belt and in the Civic and Central Cultural District area. Some also in the Marina area, as well as in the Tanjong Pagar area, and then one at Novena, which is the Oasia Novena. So in summary, we have 2 Oasia hotels, one in Novena, one in Tanjong Pagar, 2 Rendezvous hotels, which is the Rendezvous at Bras Basah, as well as the Orchard Rendezvous Hotel, which used to be called the Orchard Parade Hotel. And then we have 3 village hotels, which are the Albert Court, Bugis, and Changi, and also 2 hotels at the Orchard Road, the Mount Elizabeth area, which is the Vibe Hotel, which used to be called the Elizabeth Hotel. We renovated that and reopened with a new brand called Vibe, which is an Australian brand, and that is next to the Quincy Hotel. And 3 service residences, 2 under the Village brand, and Adina, which is along Penang Road, that used to be called the Regency House. Just further elaboration about master lease structure. All the properties have a master lease of 20 years with an option to renew for another 20 years. And all these are with companies related to Far East. And we have a fixed rent component today totaling $63.5 million, and a variable rent component which is dependent on the performance of the gross operating revenue, or what is denoted as GOR over here, and an average of about 30% of the gross operating profit. Each of the properties have a different percentage for the GOP, depending on how much we can really get out in terms of the rental income, while having a sustainable rent that the master lessee can provide without not being in a loss situation on a long-term basis. So together, the fixed rent and the variable rent will form the master lease rental, or a gross revenue for the hotel and the service residences. And I'll elaborate more about what was the advantage of the fixed rent, especially during the pandemic period. For the master leases, we also have 2.5% of the GOR that's been committed by the master lessee to be applied towards all the fixtures and furnitures and equipment in the rooms, so that rooms and the property are well kept to standards required by the guests. The breakdown of the revenue, of the gross revenue for the REIT, you will see that 60% comes from the fixed rent from the hotels and the service residences. And then we managed to generate $27 million in 2023, which formed 25% of our gross revenue last year, and with another 15%, or about $16 million, coming from the rental revenue of the commercial premises. How we continue to enhance the portfolio for greater return would be in these 3 areas. One is in terms of acquisition, where we acquire yield accretive properties to help to improve the returns, not just to grow the top line, but more importantly, to grow the distribution at the bottom line for investors. In 2013, we acquired a Rendezvous Hotel from Straits Trading. In 2014, we also went into a joint venture in the development of the 3 hotels on Sentosa, which today you'll see in the Village Hotel Sentosa, the Outpost and the Barracks, on a piece of land that Far East won in the tender from Sentosa Development Corporation. In 2018, we further acquired the Oasia Hotel Downtown in Tanjong Pagar, the hotel with the pink structure and with the greenery growing on the frame of the building. So these 2 were very good acquisition, good properties that help to generate good income for the REIT. And at the same time, another area that we also look at in terms of potential opportunity and unlocking of value is through the asset recycling. We don't try to just buy and then just sell the properties, but what we did was to actually go through a master planning process to improve and increase the gross floor area and also get a rezoning for that site of at Central Square before undertaking a divestment process. And we completed this divestment in 2022, which helped to unlock a lot of value for the REIT, selling the asset at 80% profit above the investment cost of this service residence. At the same time, to continue to grow the REIT, we'll look at the pipeline assets of this, what is called the first right of refusal or ROFR from our sponsor from Far East, for properties that have been developed and stabilized over time. And when they are ready, if we can get a accretive yield from all this acquisition, then it'll be time for us to discuss with Far East to make the acquisition. At the same time, we're also open to third-party properties in the market if we can buy them at a good price and can generate a good yield for the REIT. Example of some of these ROFR properties would be, for example, at the Far East Square, there is an Amoy Hotel, which is converted from conservation buildings at Far East Square. And next to it on the empty plot of land, a new hotel was built, and there's the Clan Hotel. And the two together would form about 350 keys in this hotel, which is at Far East Square. At the same time, we have a 30% stake in this joint development with Far East in Sentosa, which give us 839 keys or rooms in these three hotels. And they were opened in 2019 and unfortunately were affected by COVID and reopened again about 1.5 years back. So when this stabilized in terms of performance, this will be another possibility for us to consider for acquisition, for us to buy the remaining 70% stake that is owned by Far East today. In the west, there is a service residence called Oasia West Residences, which is next to the Sea Hill condominium. This, just like the rest of our service residences, are performing very well occupied, and this will form a potential acquisition target for us at the right time as well. Next, I'll go into the financial highlights just to give you a flavor of how we performed in 2023 after coming out of COVID. For last year, in terms of our gross revenue, we grew close to 28%. So it was a very strong performance by our hotels as they recovered from the COVID situation, with 2022 being a partial year when the government opened the doors for visitors to come in. And then we have one full year in 2023, which led to a big increase in terms of the contribution from the hotels. For the service residences, we did very well. Later you will see a chart whereby we performed well in 2022 given the demand for a long stay product in Singapore, and we continue to move up in terms of our rate in 2023 that gave us a close to 8% growth. But this is not on the same store basis because we divested Central Square in March 2022. So on the same store basis, if we have taken out Central Square in the computation, the revenue from service residences would have grown 17%. And likewise, in Central Square, there were offices and retail spaces. And again, if we have stripped out the contribution from Central Square, the commercial premises would have generated 13.7% more in terms of revenue in 2023. All this flow down to 27.7% increase in net property income, and similarly in terms of income available for distribution at $75 million for the full year of 2023. For the distribution to staple security holders, in addition to what was available, we also have $8.2 million that were distributed from other gains, and largely this was from the divestment gains of Central Square. The board had made a decision in 2022 to give out $24 million to our investors spread over 3 years, which then translate into $8 million a year. And that the second tranche of $8 million was made in 2023. In 2022, it was a partial 9 months equivalent because the divestment was completed at the end of March 2022. So it was $6 million in 22 and $8 million in 23, in addition to some small gains from tax exempt incomes. So in total, the distribution per staple security came out to 4.09 cents, which is a 25% increase over the previous year. As you can see from this chart, before COVID, FEHT generated a distribution per unit of 3.81 cents. And then because of COVID, it dropped to 2.41 cents before recovering in 21. And further in 22, and for last year, together with the other gains that we distributed, we were able to have a distribution per staple security of 4.09 cents, which actually even surpassed what we distributed pre-COVID. And just to highlight in terms of the yield, James, you can go back one slide. Yeah, if you can see, the yield pre-COVID was 5.1%. based on the prevailing share price at the end of the year of 2019, compared to the closing price at the end of 2023, which was about 66 cents. And that, based on 4.09 cents, we have generated a yield of 6.2% for investors. Last year, we had a gain of we have a gain of about $50 million or $59 million, which represent a 2.6% increase in terms of the value of our assets. And that came from both the hotels and the service residences, with a slightly bigger gain from the hotels, 2.7% and 1.7% coming from the service residences. I suppose that maybe to stand in contrast with some of the other REITs where they had overseas assets and whereby there were currency issues and also perhaps impact from high interest rates in some of these countries. So for us, with properties all in Singapore, we are more sheltered and shielded from the currency devaluation or depreciation of some of the other markets. And with this assets all in Singapore, that also gave us an uplift in terms of the valuation. Just a summary of our capital management, as you can see from this chart, which has a lot of information. In summary, we had a total debt of $738 million, which was down from about $1 billion before we divested Central Square. So from divestment of Central Square, we were able to pare down about $300 million in debt. That helped to reduce the interest expense for our trust. And that also brought down the average gearing, the leverage, from 41% to 31.3% at the end of 2023. The average debt maturity has also been extended to 3.8 years as a result of early refinancing of some of the debts that were due this year. So all the debt due in 2024 have now been stretched and refinanced to 2026 and 2030. With an average cost of debt at 3.3%. So today we stand as one of the lowest geared REITs in Singapore, compared to the average or the median of about 38% among all the S-REITs in Singapore. One concern that investor has is regarding the high interest rate environment, and in particular in terms of increase in interest rates. Last year in March, as a result of our divestment of Central Square, we received an additional incentive fee of $18 million on top of what we received in March 2022 as a result of fulfillment of certain conditions by the buyer, which is CDL. So with this additional $18 million, the board has committed to use it to buffer potential increase in interest rates. And all these numbers here are illustration to say that if interest rates were to increase by 0.5% or 50 basis points, it will impact our distribution by $2.1 million. And if it went up 100 basis points or 1%, it will impact our distribution by $4.2 million. So the idea is to use this $18 million to buffer against possible higher interest expenses faced by SIAS. Next, I'll quickly go over the portfolio performance of our trust. As you can see from this chart, which is the performance of our hotels pre-COVID in terms of the revenue per available room, which is a factor of the occupancy and the average daily rate. So taking occupancy times average daily rate, we get a RevPAR, as we call it, revenue per available room, of about $141, $147, depending on the quarter or the half of the year. We went down all the way to $51 the depth of the pandemic before recovering to $60 to $116, $133 early last year in the first half, and then to $140 in the second half. So right now where we are getting close to the pre-pandemic level, above $141. For the service residences, it's a slightly different picture. Pre-pandemic, the RevPAR, as we call it, revenue per available unit, was around $170, $180 all the way up to the end of 2019. And then at the beginning of the COVID, with some of the expatriates leaving and people not being able to send their staff over to Singapore for project work, the service residences also suffered. But it recovered very quickly in 2022, given the tight supply and also the strong demand for long stay accommodation. And by 2023, it has gone way above what we have achieved for service residences. And in fact, this number that we have achieved, 234, is the highest that we have recorded since our IPO 10 years ago. In terms of the mix of our gross revenue, so this chart will illustrate the different components. The fixed rent, which you can see stable at $63.5 million, taking out Central Square, which was divested, so that we can have the same store picture. In 2020, it went slightly below 63.5, and that's because of the mandatory return of the stamp duty that the government asked all property owners to do. Otherwise, the fixed rent will remain fixed as long as Far East is able to pay the rent, even during a crisis like a pandemic. And the variable rent will grow with the performance of the properties and also will track inflation as we are able to up the rate, with rising prices and costs. So back in 2019, the variable component formed 24%, and in 2023, it was able to go up to 25%. For the retail spaces and the office spaces, the revenue last year was $16.2 million, which formed 90% of what we achieved before COVID. The gap was the result of some of our properties being in the government contract, whereby we were not able to lease out some of the retail spaces within these properties until the contract ended. So now that we have taken back all properties from the government contract, we're able to start the prospecting to get all these retail spaces filled up. Next, I'll just show you some illustration of what we have done after we started marketing to fill up the spaces post-COVID. At Orchard Rendezvous Hotel, on the second floor, Natureland has taken over the entire space to provide ancillary spa services, not just to hotel guests, but to other walk-in guests from other hotels staying in vicinity as well. So that is a tenant that generates good rents for us. Next, at the Rendezvous Hotel, which also was under the government contract until end of March last year, we were able to secure a tenant called Reverie, which provide the all-day dining operation at the hotel, serving breakfast for the hotel guests, as well as lunch and dinner for any walk-in traffic as well, with some entertainment in the evening with the stage, as you can see on the left side of the picture. At the Regency House, which is on the other commercial component next to Adina, which is the new brand for the former Regency House service apartment. On the commercial side on the ground level, this is a new restaurant that's just opened up last month. It used to be a showroom. We managed to get a change of use to F&B, to an F&B outlet, and also managed to get approval from the URA for the use of the outdoor sitting area, so as to turn it into outdoor refreshment area to add more color and life to this part of the property. Over at Changi, at the Village Hotel Changi, we also managed to secure a tenant on a rooftop restaurant space, again after it emerged out of the contract from the government. Next, I'll just highlight some of the accolades and corporate governance achievement over the last year. First, this is the Singapore Governance and Transparency Index 2023, or SGTI as we call it. It's a closely watched rating in terms of how each of the REITs in Singapore perform. And for 2023, we are pleased that Far East was ranked second out of 43 REITs and business trusts that was rated by SGTI. It's a 5th consecutive year that we are placed among the top 10, and it shows the effort and also the attention that management and the board play in terms of the corporate governance of SIAS Trust to ensure that the entire trust is well managed according to all the regulations that we have to adhere to from MAS as well as the SGX and the expectation from the market. Next, from SIAS, which is organizing this event today, we were also pleased that we emerged as a winner for the Shareholder Communication Excellence Award last year, where we were ranked runner-up the year before. And this is the 3rd time that we have won an award from SIAS in this category. And last year, we also won the Singapore Corporate Governance Award. Again, we were ranked 2nd the year before. So we are very pleased that the SIAS has recognized SIAS Trust in these 2 categories last year. And to conclude, I'll just quickly summarize the outlook for our trust. This is a snapshot of the visitor arrival and the recovery. As you can see here, as of 2023, we were back at about 73% of pre-COVID level, and this is still inching up. That will be backed by normalization of traffic, especially in terms of the air capacity between Singapore and our key markets. In terms of the Singapore Airlines capacity, they are right now at 92% of the pre-COVID seat capacity and with a high load factor of 88%. So airlines in particular will be a very important conduit to bring visitors into Singapore. Where we are lacking right now are some of our key markets like China and Japan, where the recovery is lower than some of the other neighboring countries. Upcoming tourism developments, I think most of us would be quite familiar with the rejuvenation in Sentosa, in Mandai with the various wildlife parks, and also the expansion of 2 integrated resorts, which will help to improve the attractiveness of Singapore as a destination for visitors from around the world. So in a nutshell, in terms of tourism and infrastructure, we expect to see further improvement in terms of the flight capacity, and also with the upcoming tourism products that will help to drive more tourists into Singapore. Policies such as the 30-day visa waiver for Chinese tourists also help to to reduce barrier and encourage more of the Chinese tourists to come to Singapore. And they form the largest group of tourists into Singapore pre-COVID, and they have not recovered to that state as of now. STB has also earmarked $500 million to promote and boost Singapore's standing as a business and wellness haven. So that fund will come in handy post-COVID to help the market and to improve Singapore's position as a tourist destination. Various infrastructure projects will help to improve our connectivity, both externally and within the country, and also generate project work that also help to fuel our hotels and service residences as all these professionals come to Singapore to work on all these specialized areas. On the macroeconomic front, we see continued recovery for the key markets, and we expect further improvement in terms of GDP performance this year among all the key markets. Interest rates went very high last year and are now at a peak, with expectation for it to moderate in the second half of this year, which will be helpful for all the REITs in Singapore. And Singapore continues to be very attractive as a business hub for new investment, and EDB has managed to secure close to $13 billion in fixed asset investment last year, and that will bring in more jobs, more investment that also will create more business driver into Singapore. So just to summarize our key initiatives, strategic initiative will include asset management and enhancement to further improve our existing portfolio through organic growth and unlocking latent value of some of our assets, especially through replanning, master planning, and getting additional approval from authorities for higher GFA or change of use. Next, in terms of investment, we also look for yield accretive acquisition from the sponsors' pipeline or ROFO properties, or also from the third-party assets. And lastly, in terms of capital and risk management, this is an area that we are watching very carefully to maintain a prudent level of borrowings and applying an appropriate mix of debt and equity to finance acquisitions in the future. All right. So with that, I conclude my presentation. I'd like to thank you for your attention, and we can open time now for questions and answers.
All right. Thank you, Mr. Gerald Lee, for that very insightful sharing on the latest business update from Far East. We will now move on to the Q&A segment. Do feel free to submit your questions. I already see a lot of questions coming in on the Q&A. We do have some pre-submitted questions as well. For our viewers on Facebook and Moomoo, do click on the link to join us in Zoom if you would like to post your question. We will try to get to as many of them as possible. So without further ado, let's move to the Q&A session. So Mr. Gerald Lee, I will be going through the Q&A session. One of the first questions that came in from Mr. Ramesh, one of our viewers, is FEH gets about 92 million of revenue from hotel via leases and GOR. So what sort of a total revenue do the combined master lease make? Will it be 2 to 3 times the rental they pay FEH?
Can you repeat the last part?
Yes, so Far East the REIT right, actually pay the rental to Far East Hospitality. So when we make the total revenue combined from the master lease, how many times is it from the rental that we are paying Far East Hospitality? If you can give some guidance on that.
Okay, maybe just I'm not sure I'm getting the question correctly, but if I were to interpret it this way, is the hotels and the service residences are generating revenues. So what they would be contributing to our REIT from the revenue. Is that what you think the question is about?
Yes, I believe.
Yes. Okay. So in general, for each of the properties, 1/3 of the revenue generated will be paid as a fixed, and another 30% or thereabout of the gross operating profit would be added as the variable rent. So the gross operating profit typically will form about 45 to 50% of the top line of the gross operating revenue. So assuming it's half, and if it's half, and then they are paying 30% of that. So which means that in total, each of the properties should be paying about 50% of the total operating revenue as rental income to the REIT on an approximate basis. If you can look at this formula over here, 33% of GOR plus 30% of the GOP. So GOP, for example, if it's at 50% of the top line, 50% of the GOR. So if I take 30% of times 50%, that will be 15%. If I add it to 33, that would be close to 50% of the gross operating revenue.
Okay, thanks for breaking down those details for us. So a follow-up question from Mr. Ramesh would be the recent visa-free travel with China. How much of a significance will that be for Far East Hospitality Trust?
Yeah, that's a very good question. For us, given the spread of our different properties in different locations and also the various brands, we are not overly dependent on any nationality coming into Singapore. So typically in a normal year, none of the nationality, or if you will, the visitors from any country would form more than 10% in totality. So which means that we have a very diverse mix of guests staying in our properties. In the more recent years, China visitors has been on the increase, and we have managed to improve in terms of the contribution from Chinese arrivals. As of 2023, we noticed that overall Chinese arrivals only form about 1/3 of what they use to contribute to Singapore in terms of their arrivals. So, for example, way back in 2019, Chinese arrivals would be more than 2 million bodies a year coming to Singapore. Last year, it was only about 1/3 of that. With the 30-day visa-free policy, we are starting to see more Chinese visitors coming into Singapore. So in January, we noticed that the Chinese arrivals formed 70% of the pre-COVID level on the same month basis. So it has actually moved up from 30% for the full year last year to about 70% in January. We don't have the visitor arrival statistics for February yet, but we also, based on the visual observation, we are also seeing many Chinese tourists around us in Singapore this month. So hopefully this policy change will help to encourage more Chinese to feel free, with less restriction, especially in terms of need to apply for visa to come over to Singapore, and particularly for those who want to stay a longer period of time. So January, if it's an indication, I think that is a good sign in terms of welcoming more of them back to Singapore as compared to the lagging performance that we observed last year.
Okay, so I think this visa-free travel will definitely be a plus sign for Far East Hospitality Trust going forward, especially it's just been approved in February. So that will bring up the numbers, and hopefully we can see the previous peak of the Chinese arrival, which will help Hospitality Trust as well. So the next question will be from Mr. Daryl. We are back to the pre-COVID RevPAR already. I believe that's on the hotel side. So what about the revenue from the service resident sides? How has the performance improved?
Okay, if you look at the RevPAR slide, for the hotels right now, we are at about 90%, 95% of the pre-COVID level. So we'll bring up the chart very quickly. Okay, the one before that, maybe James, just for reference. Okay, James is my colleague who is helping to control the slide. We are at 140 for the second half of last year, so it's close to 95% of the pre-COVID level. The hotels, because we have some hotels that came out of the government contract last year, including one that emerged at the end of 2023. So as they come out of the government contract, there's some ramping up to do as we go after the market, especially the corporate accounts, to make it known to them that they can start to put guests with us. And also the need for us to fill the retail spaces, particularly when there's a need to have an all-day dining operator to provide breakfast for our guests. So there will be a ramping up to do. So I think for the hotels going to 2024, we would continue to want to inch up to get above the pre-COVID level. For the service residences, if you can see from this chart, actually it has already performed well above the pre-COVID level in 2022. So 2023, it went up even further. Of course, this was partly caused by the tight supply of residential units in the market, including residential apartments available for lease, and also the relocation of many of the expatriates out of China and Hong Kong the year before, starting from 2022. Some of this have normalized, and more supply also have slowly streamed into the market with the completion of some of the properties and condominiums. So we are starting to see a bit of easing on the rental market, but for the service residence supply, it's still very tight because not many developers will want to build service residences for investment, as in to hold, to rent out, because it's a very deliberate decision, because both service residences and residential properties are sitting on land zone for residential use. So for developers, most of them, when they get a piece of residential land, they'll build to quickly sell them to generate the revenue so as to churn for the next project. For a developer like Far East, because of its diversity of business, the company makes a deliberate decision to also invest not just in hotels, but also in service residences that are geared for long-term leases that would then generate a different stream of income to diversify from the shorter stay hotel business and also from its other leasing business in the retail spaces, office spaces, and residential properties, etc. So the mature and stabilized asset will then divested into REIT for us to continue to manage it to optimize the performance. So I think the service residences are at a good point in terms of the equilibrium of the demand and supply in Singapore.
Hey, thank you for that answer to Mr. Daryl. So there's a next question from one of our viewers, Mr. Huang. I think it's counterintuitive that the long-term stay RevPAR, the service residence slide that we are looking at right now, the price is actually higher than the short-term hotel rent revenue. So how is this? So is this part of the explanation that you given earlier, and is this trend likely going to continue?
The RevPAR for the service residences much higher is because the service residences actually comprise apartments that are starting at a much larger sizes than hotel rooms. For example, the studio unit typically be like 40 to 50 square feet, and it can go up to 3-bedroom apartments that are maybe 120 square meters, which are much larger than the hotel room size of averaging, say, 25 square meters. So the studio apartments, 50 square meter, will be like double the hotel room size, and then the larger units can go up to 80, 100 square meter, and then and therefore being able to accommodate more people, like a family, or maybe for a company with a project group, they may be able to put a few employees into a larger apartment with the staff taking a bedroom each. Therefore, we are able to charge higher rent for those units. And typically, the contract will go for at least a week and above, averaging overall about 1.5 months for portfolio for the service residences. So it gives more stability in terms of income, with each unit generating a higher rent, and at the same time, given the lesser need for servicing and maintenance and housekeeping, we're also able to get a better gross operating profit margin from the service residences as compared to the hotel, which has more people checking in and out on a very short-term basis.
Okay, understand. So we can't really compare apple to apple on that because the properties are different in sizes, hence the difference in the rent as well. So the second part of the question is, if will there be any changes in the portfolio mix going forward between the service resident and the hotel?
We do not have a predetermined target mix per se to say that, for example, now we have 9 hotels, 3 service residences, and the contribution from the hotel, for example, at 60%, compared to the service residences, say maybe like less than 20%. We do not say that we want to move towards 70-30 or whatever that we think is ideal, because both of them are actually targeting and catering to different market segments, and they can stand on their own. For us, I think what is more important is what is available, both from the sponsor and also from the market, that we can acquire at a good price that can give good yield accretion when we acquire it, to help to contribute towards the distribution and the DPS to investors. So pretty much it will depend on whatever that is stabilized, that is performing well, that we acquire. So in due course, it could be hotels, whether from the sponsor side or from the market, or service residences. Looking at the ROFR properties right now, it looks like there are more hotels that are available from the sponsor than service residences, which is number 4, as you can see from this slide over here. And this also points back to what I just mentioned, that there are not too many residential plots that are available or that are used by developers to build service residences, because most of the residential pieces would be used by developers to build residential apartments for sale. But from time to time, in a big mixed development like One Holland Village and also the Reserve at Bukit Timah, our sponsor might, and in those 2 cases, have reserved a block of service residence among the various blocks of residential apartment built for sale. So beside this, that you see over here, at the One Holland Village, there'll be a new Quincy residence, which eventually will form another pipeline asset for us. And again, at the Reserve residence in Bukit Timah, there'll be a block of service residence that also, when ready, will be another target for us as well.
Okay, thanks for that answer. I think I'll move on to the next question because we are like close to 8 p.m. If FETH looking to expand overseas, that's a question from Mr. Terrence. If so, any plans for equity fundraising?
Yeah, thanks for this interesting question. First, to answer the second leg of the question, we do not have any intention to do equity fundraising in the foreseeable future, at least not in the short term. As I mentioned earlier, we divested Central Square for more than $300 million. In fact, the total consideration came out with the $18 million incentive fee. It amounted to $331 million. So our leverage right now is one of the lowest among all the REITs in Singapore. I think it's perhaps the third or the fourth lowest, which means that we have a lot of debt headroom that can fund our next few acquisitions. As to where we will be looking, currently the interest rate environment in Singapore is still fairly high. Total costs of borrowing for a new loan to fund a project would be in excess of 4%, which means that if you were to buy something yield accretive, the yield from the asset would have to be at least, say, 5.5%, which then mean that the sponsor or the seller will have to sell it at a low price. It's an inverse relation. So realistically, for this year, while the interest rate is still at this elevated level, I don't think that we will be able to make an acquisition unless the sponsor is prepared to give us a discount to make the deal yield accretive. In terms of where we could consider investing, I think overseas acquisition is something that the board has considered, and definitely we'll be looking at possibility of expanding overseas so that we can provide some diversification in terms of earnings for our trust. And we will be looking at countries where our sponsor has already gone, namely Australia, Japan, and a little bit in the UK. Of these three, I think in Australia and UK, the interest rate environment also are very high. So that also would rule it out for us to look into those markets. Japan looks more friendly in terms of the interest rate environment, which means that we are able to buy a property with a yield that is not exceedingly high as compared to the borrowing rate. So, but in the overall scheme of things, our focus will still be on Singapore. So for the long term, Singapore will still form the mainstay of the composition of our portfolio, and we would have a diversification target maybe over a long-term period of perhaps up to 20% to provide a balance and also some diversification in terms of earning should there be a cyclical downturn in Singapore in the future, so as to have a counterbalancing income generator from elsewhere. That is the train of thought. We are not anywhere close to making any acquisition overseas, but we are open to it and would look for something suitable to complement what we have in a stable environment that we enjoy in Singapore.
Okay, we'll look forward to that high updates from you if there's any development on that side of the acquisition. So it's past 8 p.m. already. Let's just take 3 more questions. One more is Mr. Marcus Sim. The increase in concerts such as Taylor Swift, Coldplay, and the recently Ed Sheeran concert, together with the annual events like F1, have this contribute more positively to FEHT revenue?
That's a good question, Marcus. For sure, the mega events, not just major, mega events definitely help to bring more visitors into Singapore. And we have seen that in January with Coldplay, whereby all the hotels in town were running at more than 90% occupancy. And we expect the same based on forward booking patterns for the first 9 days of March when Taylor Swift will be in town. These are events that have global appeal that can help to bring in people from around the region to attend because they don't have such concerts in their own country. Other major events like F1, they have been ongoing for a while already. Of course, during those period of time, companies may entertain their clients from the region to bring them in. And likewise, racing fans also will come to Singapore. Over time, I would say that the impact from F1 would be less than for all these entertainment events, just because the government has imposed a levy on which is collected by the hotels for all the people staying in hotels in Singapore. For trackside hotels, the levy is 30% of the room rate. For off-track, that means anywhere else other than the marina area, we have to collect 20% more in terms of the room rate. So if the room rate is $100, we have to charge $120, and that additional $20 goes to the government for them to fund the F1 event. So as a result, the higher pricing also is a limiting factor in terms of the ability for us to really bring in a lot more people. But from time to time, it does help to if there, especially when after COVID, when there's excitement for people to want to return to such events, there is a spike. But over time, I think there's some normalization because all these events has been running around for some time. In general, I would say that when we have big events like the air show, for example, or big trade show like Food and Hotel Asia taking place in the city, it helped to bring in more arrivals that then lift the whole tide. So when the whole tide has moved up for hotels in Singapore, then all the players are able to charge higher rates, and everyone will be more confident to maintain rather than during a time when it was dry and everyone start cutting prices, and then that affect our ADR and our RevPAR.
Okay, thanks for sharing the insights on the levy as well on these mega events that you mentioned. So the one question from Mr. Jeffrey Ng is, how is the variable rent formula negotiated with the sponsor as the interested party? Are they operating costs borne by the tenant? Are the operating costs borne by the tenant or shared with Far East Hospitality Trust?
For the master lease rental structure, there was referencing done with hospitality REITs that were already in the market before we listed Far East H Trust. We took reference at that point to 2 hospitality REITs that were already in place, and at the same time look at the revenue being generated by each of the properties to ensure that after paying this rent, both the fixed and the variable rent, the property itself is able to sustain and generate a level of net income that would be feasible for the master lessee to continue this lease for the longer term. It shouldn't be a situation whereby, for example, if the property is generating $100 in revenue and is paying $120 for the next 20 years, so the master lessee will be in a loss-making position, which then make it unsustainable. If of course, the master lease rental structure, we have to make certain assumption, but the idea is that there is minimum retention at the master lessee level after the property has paid the rent and paid the hotel operator the management fee, so that we are in a situation whereby the property themselves are able to sustain after paying the combination of fixed and variable rent. In terms of operating costs, all this would be what is found below the GOR. So the GOR is the revenue generated at the top. The operating expenses would then be deducted from the GOR to reach the GOP. So the REIT FEHT does not bear any of the operating expenses at the property. The expenses that we have to bear after receiving the master lease rental or the rent from the hotels and the service residences would be the property tax that we have to pay to the government, as well as insurance premium that we have to pay to take up for property damage, for all risk, fire, etc. So from the gross revenue of the REIT, which is the combination of all this revenue that you see on the right hand side, we will have to deduct the property tax and the insurance payment to reach the net property income, and not pay for the operating expenses of the property. So if we go back a few slides, just to show you again, to help you understand better the financial breakdown. James, further down, sorry. Next. Okay, as you can see, the gross revenue was for 2023 106, net property income 98 million. So the difference between the two would largely be property tax that we pay to our government and some insurance premium, which is very different from the gross operating revenue of the hotels and the gross operating profit after deducting the operating expenses. So the NPI income margin, as if you can call it that way, is a very high percentage because there's not much operating expenses that the REIT would bear.
Okay, so I think that will answer Mr. Jeffrey Ng question on the rent formula. Okay, I think that we take one last final question. I think that's from myself, from SIAS itself. For the
ago. And right now, our average cost of debt is 3.3%. We try to fix, we do not want to fix all our loans. Right now, it's fixed at 41%, and our target is to keep it at about 50% fixed, with the balance being on floating rate. So if the floating rate were to come down, as we were expect in the second half of this year, that means that we'll pay less interest expenses to the bank for the 700 million of loans that we have. And that would mean that we will have more income available for distribution. So between the MPI line that you see here and the income available for distribution would be a large part of it, the interest expenses, among other things. So the less interest we pay, the more income available for distribution that we have to investors. Of course, cost will be another factor. We went through that during COVID. That is a potential risk, but I think that perhaps the worst is over. For example, electricity prices went up more than 100% in 2023. I think it's about 120, 130% higher than 2022 based on the tariff rates. The good news is that it's come down. It has come down more than 30% for 2024 based on the new contracted rate. I think it's about 1/3 lower than last year. So with more normalization of some of this supply chain and also some of the imported goods and materials, we hope that we will not have to bear more of the elevated cost of operation that also will impact our revenue. So I think both on the interest expense side, on the operating cost due to inflation, I think this will be the more immediate. This will be the more immediate challenges that we have to deal with. Over the medium term, of course, our interest is to continue to want to grow our portfolio to a bigger size so that we can have more diversification, more liquidity in terms of our units, to be able to attract larger investors, particularly the institutional investors. So right now, our market cap is about $1.2 billion. Our aim is to double that over time. Hopefully, it would not take more than 5 years. For the time being, it will not be appropriate for us to mount any equity fundraising. But at the right time, when there's a better recovery in terms of performance and our share price, and then when we are acquiring some of the major assets from the sponsor, maybe a few years down the road, when the environment is suitable, this acquisition could be supported by equity fundraising so that we can grow our market cap to be able to be a more sizable REIT than what we are today. And we will attract bigger investors to come in. That also will give us a better re-rating in terms of our share price and hopefully to bring it further up from where we are today.
Okay, thank you, Mr. Gerald, for this sharing. I believe the security holders are all looking forward to interest rate coming down and cost coming down, and hence the DPU will be higher going forward, and all business will be better for SIAS Hospitality as well. So thank you for taking time from your busy schedule to join us on this Corporate Connect. We hope that everyone that's joining us today in this session found the session useful. If you have additional questions, I do see additional questions on the Q&A. Yeah, feel free to contact the company IR. Their website is fehtrust.com. And if you miss any part of today's session, you can rewatch the webinar on our SIAS YouTube channel. Corporate Connect is our monthly webinar. Do visit the website to get updates for upcoming investors education program and initiative. You may type in the chat box to let us know which listed company you would like us to feature next. Our next Corporate Connect webinar will be on 12th of March, featuring UOB Group. We hope to see you then. And thank you, everyone. Thank you, Mr. Gerald Lee. Take care and have a good evening.
Thank you, everyone. Bye-bye. Thank you.